Well, a very warm welcome to you, our clients and friends. Greetings on behalf of your entire financial team, including Tim, Adam, and myself. It's a pleasure to conduct this very timely event. I think you'll enjoy it and find it very informative. We have a number of folks attending. Just so you know, we've got registrations, 157 registered, 255 potentially attending, over 12 states. So I know this event is very timely. We're happy to bring it to you. This is our first in our 2026 Client Education Series. As you know, in our education series, we've had in the past seminars and sessions on topics that are of interest, from estate planning to Medicare to Social Security. So we're excited to bring this topic to you, which obviously is quite timely. As a reminder, you as clients, you've got an investment account with Paul Ried Financial Group, but you're also included in our proprietary PEAK program. That's PEAC. And it stands for, and you're all part of this, the P is for planning. So as you know, what we've done is sat down with you and gone through a series of questions and gone through planning sessions that help you understand if you can retire, when you can retire, how much you can spend. We talk about various aspects to really clarify your goals and then set an investment strategy in line with those goals. But what that E is about, PEAC, E is about education. As you may know, I taught classes for 20 years at the Boeing Company. Education is still the hallmark of what we do. And the education is one-on-one during sessions that we have. It's virtual, such as this. We began this, of course, post-COVID. And it's also the capstone event is our annual fall client in-person education economic outlook. So we're very important education to help you make informed decisions. And then in that PEAK program, the A is for advice. So any financial decision that touches your life, we want to have a resource or an opportunity to help you make that decision, whether it's a resource inside our firm or outside our firm. So it's the planning, the education, the advice, and lastly, it's consulting. And the consulting, again, a hallmark of what we do. We have meetings with most of you on a semi-annual basis, and those regular sessions are around estate planning, insurance, investments, tax strategies. We're helping you get better informed about what's ahead, whether it's Medicare, required distributions, and obviously things come up that you might bring up that are particular to you, and we're here to serve you. So we're very thankful for your support, your encouragement. Folks, I want to personally thank you for your confidence, your trust, and the loyalty you've placed in us. An outgrowth of that, Forbes annually selects some of the top advisory firms and top advisors in the country. And I'm very pleased and fortunate that we've been on that list for some time. 2025 list came out with the top registered investment advisory firms in the country, and we're in the top 250 in the United States. And then of late, just last month, the top advisor nominations came out, and they look at the top in the state, and number 3 in that group in the state, and also in the top 250 in the country once again. But our biggest accolade is your support, your confidence, because our undying support is for your success. Part of that is the education system and program that we have through our Client Education Series. So we're going to get started. And so what we're going to do is I'm going to go ahead and pass this on. We're truly humbled, by the way, by your support. I'm going to pass this on to Tim, our Chief Financial Advisor and Principal of the firm. He's going to introduce our topic and the format for today's event. Thank you.
Yeah, thank you, Paul. And again, welcome everybody. So good to have you here on a beautiful Tuesday morning. And topic, obviously, that we're going to address is what's on everybody's mind, of course, the war with Iran and just what's going on within the economy, this K-shaped economy of ours that's been amazingly resilient. And so we're going to dive into some of these particular topics. As Paul mentioned, my name's Tim Kimmel. I've had the pleasure of working with a lot of you. I've been here with Paul and growing the firm here for going on my 34th year, coming up here in July. And it's been an absolute pleasure to serve alongside with Paul and obviously the other team members that we have here at Paul Ried Financial Group. As Paul mentioned, our top priority, of course, is to keep you as informed and as secure as we possibly can, of course, in these uncharted, right, ever-changing landscapes that we experience. And definitely the topic today is right up that particular alley. So today's session, we plan to tackle really two significant forces shaping the financial landscape in real time. All right, the economic ripple effects, of course, of the Iran war. So we're going to address some of that, plus the divergence that we're seeing within our economy, which is known by many economists as this K-shaped environment, right? Where you have some that are doing quite well, others obviously not, participating as well in that. So really, we're going to kind of tackle those two subjects and obviously everything related economically to those things. Today, again, it's not our goal to predict the future of course. That's impossible. It's unpredictable, but it's instead to really help you understand some of the mechanisms at work, understand obviously some of the dynamics of our plan that we have in place for you, and obviously how we're managing through this volatility. See, the folks, sometimes the objective that many people have is, hey, I want to sidestep the events, right? And obviously, if we knew what the future held, we would obviously try to do that ourselves, but nobody knows that. And so, as you know, what we try to do, instead of managing around the events, we do our best to manage through the events. And again, each one of you have a specific strategy, which again is tailored specifically to your goals. And so we're going to dive into some of the historical perspectives, especially related to conflict, and also to kind of what we're experiencing within the economy right now with this kind of divergence in the consumer arena. So before we dive into that, however, a little bit of housekeeping. So first of all, our time today is going to go about an hour. We do want to try to respect your time, so we're going to try to do our best to keep it within that time frame. That's going to be divided kind of into three segments, as it typically is for some of you that have attended before. There's going to be about 20 minutes, and Adam has some prepared slides that we've all gone over that we think will be quite helpful in putting some perspective in place related to some of these things that we're experiencing. So Adam will speak for about 20 minutes and share some of those slides that, again, will be, I think, very helpful. The second 15-20 minutes will be Paul and I answering some specific questions that we've been getting a lot of during our planning sessions. Obviously, we meet frequently as an advisory group, and Kelly, Georgianne, Ken, Paul, and myself, of course, all again talk about the questions that we're getting. And so we've taken some of the top questions that we're receiving as an advisory group, and Paul and I are kind of go back and forth and kind of addressing some of those key questions. And then the last 15-20 minutes, right, will be your specific questions related to some of the things we're dealing with, topics of our webinar today. So if you're curious, right, how to ask a question, again, if you scroll along the bottom, there's a chat box icon. You just click on that, and then you can type in your question. What we'll do is we'll collect those questions, and then at the end, I'll go ahead and pass those questions on. Paul will take some, Adam will take some, I'll take some. I'll direct those to the right spot, hopefully. If by chance we don't get to your question, we'll try to get to as many of the questions that you have as possible. But because of time constraints or something other than that, right, we'll have one of our advisory team members reach out to you to answer that question specifically. So again, that's a little bit of housekeeping. The other thing too, I wanted you all to know is that this is for sharing, right? Again, if you have friends, colleagues, associates, right, family members that you feel could benefit from these webinars, right, share it. This is really designed to be kind of helpful not only to you, but to, again, people in your influence and circle. And again, please be sure to invite folks too in the future if that's of interest to you. So the other thing too, one more housekeeping item, is we are recording this and we will have it replayed. So again, that's the way you can share with family members or colleagues or friends if you feel like that it would be helpful. So also the slides that Adam will have, those will be made available as well. So again, we'll make everything available. One of the things that's key to us in any relationship, quite honestly, but it's particularly our focus on you, is really three founding components. Paul mentioned the Peak program, right? That's a customized program that we've developed just for our clients. But also within that, right, there are three elements and frameworks that we work within with every one of you. One is that we recognize that trust and confidence is not something freely given. It's something that we have to earn time and time again, and we work hard at doing that. Second thing is managing expectations, right? So, yeah, there are elements of obviously how we manage money that we believe is consistent with your goals. So we want to make sure we work within those realistic expectations. That's very important to have those. And then the last, which is really part of our goal today, right, is to keep you informed and to provide information so that we can make informed, wise financial decisions, of course. So that's our goal. Also, again, if there's other questions that come after the webinar, don't hesitate to reach out. We're here to help you. But with that, I'm going to invite in Adam. And Adam, like I mentioned, will go through some of the slides that we've got ready for you. And so, Adam, I'll pass it on to you.
Thanks, Tim. As he mentioned, we have a lot to go over kind of in this 20-minute period. But I do want to start kind of with a full disclosure, which is, I like charts and I like numbers, but I understand that, not a lot of people like charts and some people like numbers even less. But with that said, I do have 6 charts that I'll be kind of going over. Some of them have a lot of numbers, some of them don't, but you don't need to really worry about all that. All the details. I'll kind of walk you through some of the charts and tell you kind of the important points that we're kind of taking away from them. They're really just there so we can explore some concepts. With that said, what we'll be starting with is, because I know it's top of mind for a lot of you, which is the Iran war. We'll kind of dig into the historical implications that we've seen from different military events, different geopolitical conflicts, kind of how that's translated into markets and how we think about the current situation and how that translates into your portfolio and what we think might be unique in this situation. Then we'll kind of pivot, and as Tim kind of alluded to, on the K-shaped economy. You might be hearing a lot about the K-shaped economy, or maybe you've never even heard the term. So I'll kind of get into that, explore some of those ideas, and kind of talk about, how that plays into the, what you're reading versus what you're kind of seeing with the markets, maybe what people are experiencing in the real economy versus kind of the resilient markets, and maybe why that is the case and how we should think about that. And it ties into jobs, consumer spending, a whole lot of different aspects, I think. And then finally, we'll kind of wrap it up, let us know, let you know how we think this ties into your portfolio. But also, I'll leave a lot of that also for Paul and Tim in their Q&A. A lot of the questions that they're getting on their day-to-day meetings, they can kind of translate that for you as well, the way that you should be thinking about that in your day-to-day planning. But we'll go ahead and jump right in. I'll get a first slide that I'll kind of share here. It might seem kind of counterintuitive, but it's kind of showing you how markets have historically responded to wars or other military events, and pretty counterintuitive because markets do tend to brush off a lot of these events. And let me just pull up one little aspect here. All of you should be able to see that now. Essentially, what this chart is showing, again, a lot of numbers going on. Don't need to pay attention to all of them. I think the key here, though, is that we're looking at all past events from things like the Korean War, which we started in about 1950 here. So we started with the Korean War, we had the Cuban Missile Crisis, we got Operation Desert Storm, we had 9/11 attacks, all sorts of different events. We have the Russia-Ukraine situation. What's pretty telling about this, so if we look out 6 to 12 months, the median returns are really indistinguishable from any random 6 and 12 month period. Actually, if you look out 12 months, it's actually kind of uncanny. You have the median return, so that's meaning half of 1 year returns were below that and half of 1 year events were above that. was actually since 1950, any 1 year period, so 1 year rolling period, so every month go out a year, the median was actually 11.1. And so just like here, 11.2 for the average or the median of all these events. And you might be saying, where is this kind of disconnect going on? And you could even add in non-military events here that might be pretty counterintuitive. There are different charts out here that talk about these things, and they all point to the same thing. Even if we add in things like the assassination of JFK, you might think, the market was down that day, but if you go out 12 months, the market was strongly positive over the next 12 months in that case. And so as we try to digest that and wonder why that is, we kind of realize that, the markets are looking at different things than we do. We're looking at wars and we're seeing the real human toll that these things are taking and kind of the tragedy of these events. And the market kind of coldly is just looking at, how is this going to affect the earnings of the companies that we're invested in? And what you'll notice that if we think about, the current situation, if we have the, bombs dropping in Iran, is not changing the earnings outlook of Microsoft. It's not changing the earnings outlook of Apple or JP Morgan Chase. And these are the companies that are constituents of the S&P 500. A lot of the companies that would be affected, maybe think about companies that have high input costs for oil. So a lot of energy input costs. Those sorts of companies actually don't make up a large percentage of the overall market. It matters to our day-to-day lives and the sorts of companies we interact with on our day-to-day, but not necessarily those of the market. So as we think about what is affected, it's not that wars don't have an effect, though, and this is the important part that I think we should all pay attention to, which is the longer term effects. The immediate effects are not that great, and some of them don't even have lasting impacts on the market. But when we look out 3, 5, or 10 years, there can be a large shifting dynamics from these sorts of events. And this could be war related or non-war related. I mean, think about COVID. Obviously no war related event there, but a huge impact on employment. But markets ended up very strong in after 2020 and COVID. But it had ripple effects down. It set in motion the supply chain reconfiguration. All countries started to realize, we need to shore up our supply chains and make sure. People talked about friendshoring or reshoring or bringing things back in individual countries. So all these events in this war is I believe a similar sort of event, but it's kind of a cascade, I would say. So what this war actually goes back to continuing an event that we saw started last year. And so it matters because our relationships with other countries are changing. And so if we go back to last year when the kind of tariffs were announced, this caused a lot of, ruffled a lot of feathers with the rhetoric and threats of taking tariffs on, taking tariffs off. We had a lot of allies and long-term trading partners that this kind of shook things up a little bit. And so as we go on, and then this war came about, and kind of a similar thing. We're getting kind of shifting allies and those sorts of things. And part of it with this would be that we kind of bypassed when we went into this war, unlike traditional wars, where we kind of bypassed any of the allies, kind of the communication network. We did talk with Israel, but we didn't really bring in anyone from NATO or things like that. So that continued to kind of I guess, ruffle some feathers and things like that. So we had trade realignment from COVID, and this is kind of accelerated where people want to relocate their trade and who they want to deal with on an ongoing basis. And even think about, the geopolitical dynamics with, the threats or the offhanded remarks about Greenland and things like that. This does have ripple effects, and for instance, Denmark listed the U.S. for the first time as a national security threat. Denmark, so that's an interesting dynamic, and we're seeing that play out with rhetoric from Spain and Italy as they're thinking about maybe they shift some trade to China and these sorts of things. But those are just things we have to kind of digest. These are long-term things. They aren't nothing is a snap of a finger. These are just trends you have to think about when you're thinking about 5 and 10 years out in the planning landscape. With that said, I do want to kind of pivot. On the next slide, we'll kind of talk about how we're seeing how wars do not necessarily directly influence the outcome of markets, counterintuitively to what we would think. But this K-shaped economy is also pretty unique. It's been going on for some time, and so we will kind of show you what that is. And so this K-shaped economy, what is it? And there's many different aspects that people will talk about. What this chart is showing is just who makes up how can we have a resilient stock market when you're seeing news about so many people feeling like they can't keep up with the prices of inflation and these sorts of stresses that are going on. What this chart is speaking to is who makes up consumer spending. So if we break down the income groups, so you look at the top 20% of income earners with the bottom 80% of income earners. Now, there's always the top 20% have always made up a outsized share of spending, obviously. But it was, as we see in kind of the early 1990s, it was about a 50-50 split of meaning the top 20% spent 50% of the money and of spending, and the bottom 80% made up about 50%. So this has been this K-shaped trend is not new, but it has been accelerating. And as kind of highlighted here in the chart, is at during COVID was kind of an accelerant of that, and we can see obviously at the very this second chart on the right kind of zooms in. It kind of zooms into what change happened from that point, and we can see at the very beginning there's a very slight blip for the bottom 80%. And that was because of the stimulus checks and those sorts of things that went out. But quickly after that, it reversed course. And so essentially what we're seeing here is a dramatic divergence. And if we actually break down the dollar terms of this, if we look at from 2020 and we look at the increased spending by the bottom 80%, their spending went up about 27%, 28% actually. Their spending went up 28% over that period. You might say, okay, well, that's good, but inflation was ironically 27%. So in real terms, the spending for the bottom 80% has been flat. And what has it been for the top 20%? The top 20% their spending has gone up 59%. And so if we think about inflation being 27%, we're looking at a 32% real increase in spending. So their spending has really been kind of the engine that has kept the economy growing quite nicely. And if we also expand this concept a little bit, their spending's been driving the economy. The stock market has been performing well. Technology companies have been doing very well. But what we're looking at is their spending. There's a thing called this wealth effect. The market's doing well, and if the market's doing well, you see that your account balance is going up, and so you feel like you have more money to spend. And this is especially for the top 20%, because if we think about who owns most of the stocks, it's actually a similar thing, but even more pronounced. The top 20% of income earners own anywhere from 85 to 90% of all publicly traded stocks. So they are the ones also feeling that sort of wealth effect. So when you hear about the K-shaped economy, this is the dynamic that it's kind of talking about. And what we'll kind of move into next is jobs. And the job landscape has been, obviously we came out of COVID, and this chart starts in kind of the recovery period after COVID. Obviously, the recovery started pretty quick after COVID, because all the jobs are pretty much lost in the first 2 to 3 months of COVID. We lost about 20 million jobs in the first few months of COVID, and then quickly those jobs came back. I think the first by June we were getting 4 million jobs back, and so on and so forth. But what this is showing is that this is really flatlined at this point, and this we kind of highlighted here the Liberation Day. That's what it was termed, kind of that tariff announcement. When we came out with the tariff announcement, it was actually this time last year, so it was April 2nd. So we're about a full year into the tariff announcement, and as we know, the tariff announcements have changed, gone back and forth. The Supreme Court overrode one implementation of it, and we kind of redid it on a 10% unilateral basis. And this is kind of an ongoing thing, and there's talk about re-implementing them in July in a different format. But these tariffs are really causing uncertainty for companies. And this is in line with another disruption, which is AI, which is also causing uncertainty. And companies are thinking about, well, how should we hire? So we have these dual forces of tariffs and AI really causing this uncertainty for CEOs wondering what their hiring plans should be. And so we can see on the month-by-month basis on the bottom, it's actually showing, we've had 5 months of absolute job losses occur here. And that yellow chart is just a 3-month moving average. So if we look at the last year, actually, there's only been cumulatively 150,000 new jobs made. To put that in context, if we look back over the last 15 years, so kind of the recovery since a little bit after the Great Financial Crisis, so the last 15 years, there's been over 27 million new jobs added. And that comes to about 150,000 on average over that 15-year period. But that's per month. And so we only had that many new jobs over the whole last year. So this is an interesting dynamic. And if we look at those red lines talking about job losses, it is very unique. And if we go back to look at that last 15 years as well, there's only been 8 months when there's absolute job losses. Remember that the population's growing, so you actually need anywhere from 100, 125,000 new jobs just to keep the unemployment rate flat. So we've only had 8 months of negative jobs. Obviously, the 5 here since that started in January 2025, and then the 3 very dramatic job losses during COVID. And so as we tie this back into the concept of the K-shaped economy, we're wondering, well, I mean, think about how strong the market was last year. I mean, international markets did outpace US markets by about 10%, but they both did very good. So where is this disconnect? I mean, the slow job growth, almost no job growth, but the economy still continues to move on. And this comes back down to the economy versus the market. They are different beasts, and they're becoming increasingly divergent animals, I guess you could say. I mean, if we just look at NVIDIA, NVIDIA makes up 7% of the S&P 500. So it has an outsized influence on the performance of the S&P 500. But they only employ about 45,000 employees. Versus, think about leisure and hospitality. We're talking about restaurants, hotels, gyms, these businesses that we interact with every day. They employ 17 million people. So 40,000 for NVIDIA, 17 million for this industry or those industries, but yet those industries combined only make up 2% of the S&P 500. So as we can see, that's where that disconnect is getting between, the jobs of people versus the influence over the stock market. As we kind of move into the other chart, again, this is the same theme, but it's just showing, why people might feel like the economy is worsening despite the market plugging along. And this chart is showing you the unemployment rate going back, before 1950, every unemployment print, and then kind of the 12-month moving average, because it can be a little bit noisy. But that dark line is the moving average unemployment rate. And that teal dot is just saying when the unemployment rate bottoms. So hits its lowest point. So that's a good point in the economy. It actually shows that generally a recession on average had occurred within 2 months after that point. Sometimes it lagged by a couple of months. Usually led. Sometimes it led. In 1990 it actually led by 9 months. But if we're looking at where we're at now, we're looking at it bottomed in June of 23, and that's kind of been continuously increasing, but yet still no recession has kind of been triggered, and GDP has continued to grow. So this is really a part of the disconnect. And if we look at it, what's kind of plugging along is we have there's a lot of components that go into a recession call. One of them's employment. We have different spending measures and GDP figures. And GDP has been pretty strong, although that too has been slowing down. But it's kind of been held up by a lot of this. Everyone's heard about this AI build out, these data centers. These take a lot of money to build, and GDP is essentially just a measure of money being spent. And so a lot of money is being spent for these build outs, and that's been kind of holding GDP up. I mean, GDP is kind of below trend now. Last year was 2%. We had 2 mediocre months and 2 really high months. We actually had a negative month in the beginning of last year, kind of around the tariff announcements in the first quarter. And then we had 2 prints above 3. And then in the fourth quarter, it was like 0.5%. So it all averaged out. We got about a 2% increase there. But this is that part of that disconnect that we're talking about. But bringing it back to the markets versus the economy, and then we'll talk about the portfolio a little bit, is this chart. And this touches on multiple facts. This is kind of showing you the top 10 companies in the S&P 500 by market capitalization. What's market capitalization? It's essentially the value, what the markets value that company at. So the 10 highest valued companies in the S&P 500. And you can see they're color coded by the year that they kind of became, or in these years when they first became one of the top 10 largest. And this goes back, so basically 40 years. And as we can see in green here in 1985, we were talking about IBM, Exxon, GE, General Motors. Think about all these sorts of companies that they actually employed a lot of people. They did represent the economy a lot more if you're basing it on employment size than they do now. Obviously, it wasn't exact representation, but it was more representative. Those companies really did hire a lot of people and employ a lot of people. But those were also companies that people didn't think were going anywhere. They were like, well, these are, invest in these, hold them for the long term, you'll do great. But as we see through time, none of those companies from 1985 are still in the top 10 today. They did lose some stature. And as we see, as we move along, also what sticks out here is that generally the top 10 companies, they made an outsized impact on influence on the S&P 500, but they made up about 20% of the S&P 500. Today, the top 10 companies make up about 40% of the S&P 500. And as we look through kind of 1995, we can see even the companies, so none of the companies that were in the top 10 in 1995 exist. They exist, but they are not part of the top 10 today. And even if we go back 20 years, only one of those companies, Microsoft, is still in the top 10. So, and there's other research out here. We don't want to always think that what is impactful today, the companies that have leadership today will always be that way. And so that's why we want diversification. And this talks about diversification in multiple factors. Even look at, 2005. The top 10 were actually more diverse. You had an oil company, a tech company, a financial company in Citigroup. You had a healthcare company with Pfizer. So you had diversification within the top 10. You have much less, you have financial in there with JP Morgan, but you have a lot less diversification today. A lot of these are cloud providers or they're tech companies. Cloud providers, they're all very closely intertwined and do not provide that much diversification. And if you actually look at, there's other studies out there that show if you're investing in the top 10 companies, and let's say you only bought the top 10 companies, you would generally, over 5 and 10 year periods, you generally would trail the S&P 500 over most rolling 10. Yeah, there are some instances when you would outperform, but it's pretty dramatic on the underperformance side if you were to kind of buy this basket. So you're less diversified by owning these sorts of companies. And this just speaks to the dynamic of what is the market is not necessarily the economy in this respect. So when people talk about Main Street, it is very different. Main Street is everything we deal with kind of employment weighted. The market is basically just value weighted. Again, diversification is the story here. Whether it's the wars, whether it's any things that can go wrong in the world, it's about and we're not just talking about stocks. We got bonds, we got you have commodities, you have real estate. You need to really build a portfolio that's having different risk factors to be resilient through time and not and also this helps you avoid the emotional triggers of I need to get out. Is AI a bubble? If you're not overexposed to one area, you shouldn't really have to worry to that degree about these single issue worries. And just to quickly wrap up. and this is what I'm talking about. As you're investing over the long term, you're going to experience corrections. It's just an inevitability, and we plan for that in the construction of your portfolios. We're not going to avoid corrections. Obviously, these numbers here that I'm showing you are based on the S&P 500. So as we can see, over any 1 year period, you have an over 60% chance of experiencing a 10% correction in the S&P 500. Just go out 3 years, you're almost 91%. And really, this goes back to 1930. And so really, over those, the only time that you don't, only 9% that you didn't get that 3 year, that correction, 10% correction over 3 years was like this small time in the early 1990s. So you just expect it. Even in 20% corrections are what people define as kind of bear markets. People kind of pick these arbitrary numbers to give terms to, but a bear market's generally a 20% correction. And so this is showing also the likelihood of that as time goes on. These things will happen, and we can see through the long-term returns, you make it out on the other side. And kind of just an interesting factoid, a lot of times corrections stop at 19%. So the number of corrections that stop to that at 19% is pretty amazing. So actually, if you included 19%, these percentages would jump up pretty high. But hope this makes a little bit of sense. But I know the best people to put on to kind of explain how this works in your life and your planning is Paul and Tim. So I want to bring them on, and they'll answer some of the main questions that they've been getting in their day-to-day meetings. I'll just stop sharing.
Yeah, thank you, Adam. Excellent job. And just so everybody knows, Adam's our director of investment research. So this data and information are things that we pour over. Adam and his group obviously talk very consistently with the fund managers that are actually on the ground managing your funds. And Adam does speaking all over the country as well as nationally, globally too. He has an event, I believe, in Monaco. So Adam, thank you so much for sharing that information. And like I said, great perspective. But now we're going to shift a little bit here to some of the common questions that Paul and you and I are fielding. So our hour is going quickly, Paul. So again, we're going to have to maybe keep these a little brief, but nonetheless, I want to address them. So first one, Paul, is to you. So the question is, some would say, given all the things going on, in fact, I just pulled up the Wall Street Journal today. Here's two of the headlines. No ships transit straight as blockade holds up. But on the other side of the page, U.S. stock market continues to show great resilience. So Paul, some would say because of all the events, this time's different. How would you respond to that?
Yeah, well, first of all, thanks, Tim and Adam. Great job on the information. So, I would explain. So, Tim, what I would say is yes and no. If you think about it, it feels different today because there are multiple of risks happening simultaneously in issues: geopolitical, war, concerns about energy supply, inflation, domestic polarization, I guess, politically, and of course, higher valuations in the U.S. stock market. But the caution I have is the circumstances, and this is the difference, Tim, and for you out there, the circumstances we talk about, circumstances are different, but you know what? The reaction about the market is the same. I think about other times, and many of you as clients were around then when we talked about it. Remember Y2K and 9/11? I mean, we said, boy, my goodness, there's never been a time when, the computer's going to stop at Y2K. 9/11, the first time we've attacked on our soil, the Great Recession, and of course, COVID. My goodness, there'd never been a time we had this global pandemic in recent memory when everything shut down. Well, we were experiencing that, and we had that same question. So we're experiencing something right now, yes, that is different, just as those events were different, but the reactions are the same. And for market, and obviously, it's to stay invested and know you've got a diversified portfolio, hold for the long term. Tim, let me give you two questions I frequently, or two quotes. I frequently say these at some of our live events. And this is Mark Twain. This is a paraphrase, but Mark Twain said of what we're talking about right now, what Mark Twain said, history doesn't repeat itself, but it strangely rhymes. And John Templeton, the famous investor, a lot of wisdom. He was a bit of a contrarian, by the way. And what he said the four most dangerous words in the investing landscape, and you guessed it, this time is different. So I would say, yes, it's different. Market reactions are the same.
Yeah, that's great. Thank you, Paul. Another question that we get commonly asked, I'll take this one, is why has stock market been so resilient, right? Given all the challenges. Adam hit on some of those topics, but I'll condense it a little bit. The reality is that the markets simply, again, focus on the fundamentals. They don't necessarily pay attention to the headlines longer term. Short term, obviously, those headlines do affect us. And we've seen it recently, right? There's been a tremendous amount of volatility. But yet the markets ultimately have snapped back. Why? Because if you take away the conflict or the war with Iran, the fundamentals of our economy generally are still intact. I'm not saying they're perfect, right? Nothing's perfect. I am saying that they're generally intact. Adam mentioned consumer spending. Again, very uneven, that K-shaped economy, right, that we've been talking about. Very influential, very unique, actually, to some degree. But as Adam mentioned, it's been going on for quite some time. But when you have the top end of the earnings spectrum ultimately spending 60 to 70% of what's being spent, as long as that's holding up, the economy, obviously, as it relates to consumer spending, tends to be pretty good. Remember, consumer spending, folks, makes up 70% of the economy. So that's big. Second, Adam hit on unemployment. The unemployment rate is actually fairly consistent with historical norms. In other words, right now it's around 4.5%. But remember, full employment, folks, 4 to 5% in the realm of what the Fed would view as full. Now, Adam mentioned something also important, which again shows you a little bit of the cracks. Even though the headline unemployment number is fairly solid, we haven't seen the mass layoffs. We are starting to see a trickle effect of those layoffs. The problem on the other end, to Adam's point on his graph, was we're not seeing a lot of job creation, unfortunately. And so as those layoffs mount, right, as folks come out of school and looking for their entry-level jobs, that's problematic, right? Because that unemployment will continue to trickle higher. So again, you look at, like I said, Adam mentioned earnings corporately. Those have continued to be resilient. So companies have demonstrated that they can pass costs down to you and me, and ultimately, we will typically pay those costs. And so those profits continue to come in generally at or above expectation. Last quarter, I think statistically, and Adam would know this better than I, but I believe it's something like 84% of companies either met or exceeded their earnings expectations. And we're on the cusp of the earnings season right now. And so we'll get another view of that here coming up here in the next month or so. But so far, those fundamentals of the economy have continued to keep the market resilient. And again, one more thing that I'll hit on just to revisit. Adam mentioned there's a difference between the economy and the markets. That's very true. They're connected, of course. They're tied, but they're not one and the same. And so what we're seeing obviously affect the financial markets ultimately are, hey, those fundamentals at this point have not yet been affected. Now, we're not blinded by the fact that, hey, a lot of policies take time to be integrated into the economy. So these policies and these effects of war could hit us, 3, 6, 9, 12 months from now. And so again, we're managing, as I mentioned before, through those events. And we have, like I said, a diversified plan that is tailored to your goals. And so with that said, there has been a lot of resiliency. And again, we'll see how that continues to hold up, and we're continuing to stay on top of that. Adam and his group, obviously very integral in all that. And we'll continue to keep everybody informed, of course, of how we see things play out. So, Paul, question back to you now. How does the K-shaped economy affect retirees differently than others?
Thanks, Tim. Thinking about the K-shaped economy, some of that concept might be new to some of you. It might be something that you've heard before. But as we tie in what Adam said, what Tim said a bit, think about the economy on a macro level. What you've got economic indicators, company profits, inflation, unemployment. Then what you've got, think about the economy broadly. Then you've got market performance. So the markets in the economy, as we've been alluding to and seeing are different. But then there's a third component. That third component is consumer experience. And that's really how you and I and others are experiencing the very things that are facts. How are we experiencing higher gas prices? How are we experiencing higher utility costs and a loaf of bread going up? So the difference is this, and this is where the K-shaped economy comes in. Maybe you're thinking about yourself. Maybe it's kids if you've got them. There's others that you know. But think about how you are experiencing those very things. And where we think it really starts with, what is your financial starting point? So in other words, you as a retiree, most of you, you're kind of in that upper arm of the K, which is going up. So I think about a word like financially, or phrase like financially secure. You see, if you've got a pension, Social Security, you've got maybe your house paid for, or you've got a fixed mortgage. Now, and maybe you've got investments, certainly. 401k plans, IRA rollovers with us, we're managing those for you. If you think about it, you're experiencing the same things that everybody else is as far as expenses. However, you're benefiting from some of that. Think about interest rates. Well, interest rates are high if you're borrowing money, but if you're investing, well, we've talked to many of you, your foundation investments are doing pretty good. So now think about the lower side of that K, and the lower arm would be, I would say, the phrase is financially vulnerable. And these are folks different than retirees. You're up to at that point, and maybe the high income levels, financially vulnerable. Maybe you're renting. You know, maybe you've got, for example, you may not have a big IRA or 401k plan. And how higher interest rates are affecting you is you've got credit card debt potentially. You've got certainly higher borrowing costs unless you've locked in a mortgage many years ago. So all of a sudden, that loaf of bread, that gallon of gas, that meal you're going out to, the fast food dinner you're having or lunch, it affects you much differently because you don't have the financial cushion or margin that you'd have otherwise. So, Tim, the way I would say it is that you're seeing the upper arm as more retirees for the most part. Many of you, of course, out there, most of you, lower arm are those that are more vulnerable. Now, the biggest concern, and Adam brought this up too, is that gap is widening. And that's probably a very concern we have time to talk about. Another thing I would say too, Tim, just one thought after that. What we're seeing is unemployment. Unemployment's increasing. And of course, it's increasing now in many of the white collar jobs where you have, in some cases, these tech earnings, these tech salaries that are quite good. And actually, they're the ones who are spending the money. So if they start to lose their jobs, then of course, you've got a multiple effect that could potentially happen. But once again, Tim, Adam, and I want to continue to emphasize this. Your portfolio is built for times like this. That's why we're not solely based on the S&P 500. That's why we have active management. That's why we have global diversification. That's why we have some of the other components in your portfolio that are diversifiers and more non-traditional.
Great. Thank you, Paul. So another question commonly asked is, should, of course, with all the unsettled nature of where things are at, should we be changing our investment allocation because of these things? And that's a very good question, of course. And I go back to kind of a comment I made a moment ago is that, remember, folks, we have a plan. That plan's tailored to your specific goals and objectives. Those have been defined over the years we've been working together, right? Every one of you meets, obviously, with one of our team members, of course, and we're constantly reviewing those things. If we're honest with ourselves, really, what doesn't change a lot is what we're trying to, do, what we're trying to accomplish financially. Right, that stays pretty consistent, right? We've worked with folks over 40 years now. This is our 40th year and as an organization serving our clients. And again, very consistent. Those do change, don't get me wrong, but they don't change dramatically. What changes is how we feel about the events or the headlines or geopolitical events. So those are always changing. And remember, folks, we have a plan that's tailored to your goals, not to how we feel, but to what you're trying to accomplish over a 3, 5, 8, 10-year period of time. Remember, we take on a marathon concept, not a race concept, right? Adam mentioned the fact that, hey, things can shift and change, right? The idea that, hey, there's this divergence going on in the economy. And again, it's maybe a little bit different than what we've seen before. But again, what we do know is good companies, right, that we're focused on and trying to buy at discounted prices, they can go down too, of course, but they generally don't stay down long term. And those companies have a knack of obviously navigating geopolitical, political environments and becoming more valuable over time. See, the reality is that if we have a longer term view, and the market's volatility, which for many folks will be a point of fear because, again, they're maybe misallocated, taking on too much risk because that's what happens. We wait, and then all of a sudden, hey, that risk is being rewarded, and then it's not being rewarded, and we have this big sell-off. Then ultimately, of those folks that haven't maybe rebalanced their portfolio, like we're in the midst of doing for a lot of our folks, is that, hey, now they have too much exposure to that risk. And now ultimately they're knee-jerking and reacting to that event. Well, realize what we're trying to do with our portfolios, of course, for you as a steward of the dollars you trust us with, is obviously trim some areas that have performed well, redirect that into areas that are a bit more protected, so that when we do get a sell-off, realize that's the opportunity versus something to be fearful about, right? Because again, you do want to be buying great companies when they're discounted. All I'm describing, as everybody knows full well, is just the sell high, buy low mentality. It's easy to say, hard to practice and hard to do. And that's why you have Paul, myself, Adam, our whole team, obviously working very hard at making sure, again, our plans are diversified, again, with a goal in mind, which is your specific goals. So one last question, Paul, and then we'll turn to some client questions here since, again, our time's shrinking pretty quick. Paul, here you go. Will the possibilities of a prolonged geopolitical conflict on Iran negatively affect the investments eventually?
That's a great question, Tim, and we've gotten that from a number of you. As we've talked about, when you talk to Tim or Ken or Kelly or Georgianne, we've talked about the markets are forward-looking. We tend to think markets respond to the event at the time, but in fact, they're forward-looking. So you have to ask yourself, what has the market typically priced in? Now, we believe, and this is an opinion, researched opinion, that the markets have priced in a shorter-term conflict. So naturally, when the markets, just like earnings, when earnings are disappointed, when there's earnings disappointment for the stock, that stock price goes down, even though earnings might be good. So if it's priced in a shorter-term conflict, and we do have an extended conflict, our expectation, frankly, is we could see a pullback. That could be the trigger. But I want to emphasize this. What happens over time, and remember the chart that Adam showed. In fact, in that chart, there were 17 different conflicts. The average return 12 months after that was about 7.5%. And some of those conflicts were pretty long-term. So what you find is the markets tend to react pretty quickly when it anticipates an event. And then actually what happens, it usually bottoms out and goes up before the event ends. So think about market behavior. And in fact, one of the reasons we have actively managed funds and a well-diversified portfolio versus an index, and you saw the concentrated index that Adam pointed out. Well, what we want to do is not just spread our risk, but spread our opportunity. And during times of conflict, think about profitability of companies. Think about markets distinguished between the conflict itself and emotions. There are companies that actually will be pretty profitable during that time. So the reason we have actively managed funds is because these managers are looking for the opportunities in the midst of what's going on right now and in the midst of what they see. So we're very confident in that as well. And that's why we stand by a diversified approach, global diversification, and also make sure we have assets in different sectors at different times. So and the other thing, just lastly, Tim, before you open it up for a few questions here, the portfolios that you have today, and some of you have been with us 1 year, 3 years, 5 years, some 35 years, but the portfolio you have today is birthed out of our experience going through multiple conflicts and multiple events, beginning with Black Monday in 1987. So we stand by the portfolio. Again, we have confidence in that. Is there caution about what's coming up? You bet there is. But we stand by the certainty of how we've structured your portfolio. And as Tim mentioned, the process that we use with rebalancing, and also we have the process we use for income management.
Excellent. Now, great. Now I want to bring in back Adam into our discussion. And now I want to open it up for all of your questions. I know, again, we've got bumping up against our hour, but we're going to take a little bit more time, again, with your approval here. But the reality is I want to make sure we cover some of the questions that are coming in, some very good questions. So Adam, I'll give this one to you. Robert asks, regarding the jobs chart that you showed, does it include the government jobs, or his observation is majority of new jobs were government from 2021 to 24. The majority of job losses, not necessarily government. So do your jobs numbers, does that include government job creation, or is that just the private sector or public sector? Excuse me.
Yeah, so that's that's a complete jobs, so all jobs. But yeah, if we kind of break it down, if we look at last year, for instance, 2025, it was actually while this government sector was the largest job loser, the absolute job losses was spread pretty widely across sectors. So we have you have manufacturing lost jobs, goods producing jobs were lost, retail jobs were lost. So it was actually the number of sectors that actually had outright negative numbers was actually pretty wide, but it was the government was the largest. But if we look at the job gains prior to, while the government was hiring, it was still kind of robust regardless. Even if we take out government jobs from that number, because there is a ex-government jobs number. 2024 we had 1.5 million jobs ex-government, so non-government jobs. Before that, it was 2 million jobs, not including government jobs. So we still had, so it was wide. It's kind of interesting that how the expansion was kind of throughout sectors, and the losses are kind of throughout sectors as well.
Great, thanks, Adam. Paul, question for you. It's can the war push the U.S. economy into a recession?
If you think about the answer is yes, it could, of course. But let me kind of share this too with our client. Markets also go in patterns, and every 3 to 3.5 years, going back to way in the first part of the century, in the 50s, markets tend to decline about 15% or more on an annual basis every 3 to 4 years. So could the war? Certainly it could. Could the war then trigger other events that might push us there? Absolutely. Could trigger higher interest rates, could trigger more debt. So it could, I would say this, we would probably be not surprised if we at least saw a pullback this year or next year. In fact, the concern I would probably say is if we didn't see a pullback, we might have a string of returns like the late 90s. And of course, we know what happened during Y2K. So it's kind of like the bubble's going higher and higher, and we don't want it to burst. So, but again, we're prepared with the portfolio. We want you to be prepared as far as expectations. Hopefully it doesn't occur, but be prepared it could.
Great. Thank you, Paul. Another question's coming in, number of questions, but center around the Federal Reserve, right? There's a potential change, obviously, with Fed Chairman Jerome Powell leaving and Kevin Warsh, the nominee, obviously going through the nomination process. What is the outlook for the Fed, and will the Fed be able to actually lower rates as much as possible, or as much as expected, I should say, given the circumstances with some inflationary pressure with the what Iran is bringing to the table as it relates to higher gas prices and other things? Great question. I'll try to take that one on. The Fed, keep in mind, the Fed, remember, is more than one Fed chairperson, right? They're the spokesperson for the Fed. Remember, the Fed is actually built, I believe there's 12 governors that reside over different segments of the U.S. economy. And ultimately, 10 of them are seated at any given meeting to rotating on and off. So realize it's the Fed policy group, right? The 10 governors and governesses that are making the policy decisions and voting on those decisions. Remember, the Fed chairperson is the one that's will break a tie, right? And also can bring in certain agenda items and can certainly yield influence, of course, as well. So with the inflationary pressure that's certainly building, tariffs are a part of that, I believe. You've got the oil prices that even if the Iran conflict ends, realize oil prices go up quickly, as we all know, but they come down very, very slowly. And so, again, it could be something that we deal with for some protracted period of time. So I believe, just my opinion, that the Fed is going to be somewhat hamstrung on their ability to cut rates, maybe as much as the markets maybe originally were expecting. Because generally, when you have inflationary pressure, the Fed doesn't want to add to that by lowering rates and obviously spurring on more consumer activity, which again can create higher prices. So I believe that the Fed might cut rates maybe once, maybe twice. But there is, again, the longer this goes on, as Paul mentioned, this protracted nature potentially that could develop with Iran, the less likely cuts are. So again, it is a great, greatly dependent, in my opinion, on kind of how this goes. If we find an off ramp and that we take it, okay, then ultimately the things could calm a bit. If this is long-term protracted, then yeah, I think the Fed's going to be hamstrung and we'll be dealing with higher inflation for longer periods of time. So that's one. A couple more here, and again we're a little bit over time, so my apologies. But again, I want to get to these good questions. So Art asks, Adam, I'll give this to you. He's read a number of articles and reports suggesting that the war could disrupt the Middle East petrodollar system, which the Middle East, all Middle East oil is purchased with only in dollars generally. So I guess, how do you view this and the potential of, hey, this petrodollar ultimately maybe being diminished and more of those being in, China and Russia and those type of currencies?
Yeah, and this has always been kind of discussed, and as issues pop up, it's another impetus to talk about this, but I think it's becoming a bigger and bigger issue, I think. And one thing I didn't touch on, we were talking about, beneficiaries of war and things like this, and we talked about, non-Middle East oil companies are obviously a beneficiary, defense contractors are obviously a beneficiary, but one of the biggest beneficiaries is probably Russia. If we think about the sanctions have kind of been taken off, so they're trying to sell as much oil as they can at these higher prices. They don't have to do it at the discounted rates they had to do in kind of these backyard deals before, and so I think the biggest beneficiary of this is Russia, but it does call into there have been, even before this war started, ongoing discussions, China to Russia. There's been a lot of trying to get around the dollar, and that was, from the tariffs and these other things as well, of just trying to minimize reliance on the U.S. So I think it is an issue. I don't think, again, these are long-term things that play out. So I don't think it's an immediate thing, but it's something to pay attention to.
So we'll have time for one more, Paul. So this comes from Dennis. It says many tech companies have announced layoffs, Amazon, Microsoft, etc. How do the numbers that we're seeing reconcile with the perception of Americans losing jobs from those to those from overseas getting HB1 visas? So a little bit more specific, but any thoughts on tech loss, job losses, and then obviously some of the immigration issues?
Yeah, I mean, it all comes down to employment and unemployment. When you're restricting, just keeping things just very, very specific and not political, when you're restricting, obviously, immigration, and you're limiting that, and you have job losses, what's going to happen, these companies, of course, when they are laying folks off, what they're doing is reducing their overhead, i.e. more expensive labor, bringing in artificial intelligence or technology, maintaining their earnings, and that's one of the reasons why the stock market's staying up there. So again, knowing that you have more folks on the job market, no matter from what source, it's going to increase unemployment, and that has its own problems. And the other thing is that obviously in an unemployment situation, you've got those folks that are unemployed. I think about in the Seattle area, some of the tech companies surround our offices, and you've been to some of them. I've talked to a number of folks that have lost jobs and can't find another job, and they're in the tech sector, and they're ones that have been around in the position for 15 to 16 years and in their mid-50s. So it's an interesting, there's multiple factors there. I think job losses are going to be an issue both for a consumption point of view, and also they've got kind of a knock-on effects of increasing profitability potentially, but also the other is a negative drain on the economy and purchases.
Great. Well, Adam, Paul, thank you so much. I appreciate your perspective, and hopefully this has been helpful, right? Again, we're all dealing with the headlines, of course, a lot of things going on economically that, again, seem different this time. As Paul mentioned, the 4 most dangerous words this time is different. And so even though, again, the idea is that events are always going to be unique, folks, remember, but the emotions that surround those events are generally fairly predictable, right? There's that fear emotion, there's that kind of fear of missing out emotion too, right? So again, those market swings are very much driven by the emotions that are very historically predictable. And so the reason why we share these charts and graphs and we can kind of look at history, not that it's going to, history, again, Paul mentioned rhymes, it doesn't necessarily repeat perfectly, but there are lessons that we can learn obviously from that. And obviously our disciplines that are time tested. And so again, they're well researched, they're well defined. Again, we have a plan, like I said, specifically for each of you. And again, we do not take your trust lightly. That's why we want to make sure that, again, our plans are set to your goals. That's why we review them, right? We have meetings frequently, of course, with a lot of you. And on top of that, that's why we do our due diligence and research and focus on the things we can control. Unfortunately, the headlines we can't control, but we can control a lot of the dynamics related to the investments. And one last thing here before I let you go is that our goal, remember, for portfolios is really what I'll call a dual objective, right? We want the upside, of course. We need to take some calculated risk to accomplish that in portfolios. But we also are trying to mitigate and manage risk. We can't eliminate risk, of course, right? We're trying to manage it, reduce it. If we can do that effectively, right, then we can obviously stay engaged, managing through those events, like I mentioned earlier, and that ultimately has the best result financially for investors. But I emphasize, if there's questions, issues, things that still persist, don't hesitate to reach out to us. That's why we're here. We want you to obviously, feel very confident in what we're doing as an organization. And we have a lot of confidence in what we're doing. But again, if there are questions that come up, don't hesitate to reach out to Paul, myself, any one of the team members. Again, we're here at your request, of course. So with that, I'm going to close. Thank you so much for your time. Appreciate you taking the time out of your Tuesday morning to be with us. And our next event actually is going to be slated for sometime in August. So again, we're going to have another educational series event here. Those again are the webinar events, and then we're going to have our Cornerstone event live, which is our Newcastle event up probably in the fall sometime. So again, these are just an extension of our information and education, as Paul mentioned, and on top of that, just a way that we're trying to stay connected on top of the meetings as well. So we appreciate you taking advantage of this. Share this with friends and family if you feel that would be helpful, and have a wonderful rest of your day. Thanks, everybody.
Take care.